typical Texas community bank had absolutely nothing to do with the crisis, the $1 trillion crisis that we're dealing with, and we're being made to pay for the sins of others. Consumer Financial Protection Bureau will affect the bank. It's $102 billion in assets, far more than it will affect Wells Fargo. Wells Fargo is not going to be happy about it, but they will have the personnel and the software to be able to absorb the cost much better than the $300 to $500 million bank that you've been involved with. These compliance costs could be exorbitant. We're waiting to see who the new agency is going to be, but the burden will fall heavily on community banks. The regulatory burden that I mentioned just for this new agency is not the only thing. There'll be things associated with the Home Mortgage Disclosure Act. There'll be new burdens associated with reporting for lending to small businesses. There will be many things. If you think of 2,300 pages of legislation, you're thinking about the way it works is that that's just the statutory language. If it's got 2,300 pages, federal regulations associated with this are going to be in the multi-thousands. And then Julie's bank will have to deal with dozens, at least within the next 6 months, fall, as a compliance cost associated with that. That's just regulatory burden. The cost that you add to a bank's operation, especially a community bank, which they do the bulk of small lending in Texas and in the country, will lessen the availability of business credit. Secondly, the bill in very general terms gives very broad authority to the federal regulators to increase capital. Probably necessary in things like hedge fund activity, commodities trading, some other things where they've been leveraged 35 to 1 or 40 and 50 to 1 depending on the actions that were there. It led it essentially to pour gasoline on a fire in the securitization that was going on with this particular crisis. Inevitably though, this spillover will come down to a bank, a community bank. And the bill specifically says for bank holding companies, even small bank holding companies, they've got to be as capitalized at the holding company level as they are at the FDIC insured bank level. Increased capital costs lessen just the axiom and lessen the availability of credit. Is it all darkness associated with this? I'm not sure. We're starting to see some lights and some signs of opportunity. Commercial mortgage-backed securities essentially have been dead since 2008. We have a mortgage-backed security market right now just because we have a federalized or nationalized home loan banking system. If it wasn't for Fannie Mae or Freddie Mac, both walking dead, and both have already cost us $161 billion and probably upwards of $500 billion before this is over with. If it wasn't for Fannie Mae, Freddie Mac, and FHA, 95% or 97% of the loans, home loans could not be made in this country. There has been no private secondary market for mortgages, though there probably will be after some signs of recovery. Now for commercial mortgage-backed securities, there's been the same lack of activity. But as of recently, we started to see banks like Wells Fargo start to look into private activity in commercial mortgage-backed securities, which indicates there's more liquidity in the market. The rationale that they were using was that in average in this country, commercial real estate prices have gone down 39%. They're thinking with more equity participation, some stronger underwriting requirements, they're willing to get into it. That's interesting for them because they acquired Wachovia. That Wells Fargo outbid Citibank for the purchase of Wachovia, but I think essentially what you could say, among other things, Wachovia had a very liberal underwriting stance for the mortgages, fixed payment kind of thing. But I think what really did Wachovia in was the commercial mortgage-backed securities. So the fact that you have a major player like Wells interested in this market indicate that there is some brightness in light. Now, for the bankers that are here, I cannot cover in an entire afternoon what exactly is in this bill, but if I had to summarize what the bill does, it's kind of a Valentine to Wall Street, and it's a kick in the teeth to community banks. What they set out to really struggle and resolve was the fact that we had a problem with banks that are too big to fail. I believe that the way this law is drafted, there are enough loopholes to drive through that the next time, now our mega banks are even bigger, I don't think that whoever is in next Hank Paulson will actually pull the trigger on a major American institution and say that we need to cut you down. And I think you're going to see a situation where it's very similar to the last meeting, where you're rotating Goldman Sachs individuals between the private sector and the public sector as kind of an kind of a back-scratching deal in many ways. But a Valentine to Wall Street and a very heavy burden following community banks. Before I give it over to Julie, there's one other aspect that even predated the Dodd-Frank Act. And that was the fact that commercial real estate lending, even prior to the act, starting around 2007, I believe.
Yeah, I think that's what
Late 2007, the FDIC, the OCC, and state bank examiners really came in with some, what they thought were guidances, but they're becoming very hard and fast rules. I mean, they take a certain amount of bank's capital, and if you exceeded that with loans that are backed by commercial real estate, sanctions came heavily on the particular institution. Julie can describe that better than I can. But if you combine current regulatory behavior with current federal actions, we have a difficult environment. We still have to thank the Almighty that we're living in the state of Texas and not in some of these other markets, but it's a very, very, very interesting market. For you bankers that are here and need some more information about the bill, I'm at john@texasbankers.com, and I can get you any of the information on the executive summaries and some other things on the bill. And with that, I'll leave it to Ms. Craig.
technical expertise is. Yay.
Yay.
Well, we don't want to be doom and gloom. We may feel that way, but a banker walked into a bar. Actually, hundreds of bankers are walking into bars all across America. And as a good friend of mine said, who's the president of a bank in Michigan, I didn't know you could have a bust without a boom first. And as John said several times, we are very lucky to be in the state of Texas. But that doesn't mean we escaped everything. And so I'm going to talk about the banker's perspective on the new rules and regulations. And actually, some of these are not new rules and regulations. They're just being interpreted more strictly. So let's go on and see what we can do, hopefully. Okay, as John said, I'm going to see if I can do it this way. You know, the CRE, Commercial Real Estate Guidelines, were this. Banks were, it was suggested that banks, commercial banks, community banks, would not have more than 100% of their capital in raw land or development deals. Those were lumped together. So for a bank, $400 million, my size, that would be like $45 million worth. And for years, I've had 400% in that category. I mean, 20 years, not just a couple. And overall, you were not to have more than 300% of your capital in commercial real estate of any kind, whether it was owner occupied. And sometimes you could talk to the examiners, and I went for a long time with 500 or 600%. That's our business model, we understand it, and we believe that's a lot safer than having 300% of our capital in accounts receivable loans or widget loans. So we were comfortable with that business model, still are very comfortable with that, and felt our underwriting on the front end was correct. I've heard now John Dugan's no longer with the OCC, but he and Sheila Bear have both said in public that this will become a hard and fast rule, not a suggested guideline. So that will immediately do a couple of things. It will make credit less available in some of the banks that specialized in commercial real estate because it's a numbers game, and it will make it more expensive. Isn't that always the case? And as John alluded to, the capital requirements are going to be increased. Right now for banks, they think if you have 5% or more core capital, you're considered well capitalized. That's moving to 8 or 9%. And a tier 1 or tier 2, which is just another definition that you really probably don't need to know, they say if you have 8% or more, you're well capitalized, but they're asking banks to have 10, 12, and 13% in that category. So